Welcome to the Deep Dive. Today we're focusing entirely on the IBEX first quarter fiscal 2026 earnings call.
And our mission here is simple. We're cutting through all the transcript noise to give you the actual pivotal takeaways.
We want to figure out what their, frankly, outstanding execution means for the company going forward. We are drilling down on what drove these truly phenomenal results.
Yeah, this wasn't just, a routine beat. This was a performance that really showcased the maturity of their operating model.
Right.
Management reported one of the most impressive starts to a fiscal year in their history, and it's built on two core pillars.
Okay, what are they?
Sustained double-digit organic growth and a really successful realization of margin expansion that just continues to separate IBEX from the rest of the pack in the CX space.
Okay, let's unpack this with the headline numbers because they really do tell a story of incredible leverage. And for you, the listener, you need to see the scale of this outperformance.
Absolutely.
Revenue came in very strong at $151.2 million. That's a robust, 16.5% increase year over year?
Right, but the top line is only half the story.
Exactly. When you look at the bottom line, that is where this operating model just shines.
The leverage they generated was, it was exceptional. Adjusted earnings per share, adjusted EPS, saw this massive 74.1% jump year over year to 90 cents per share.
74%.
Yeah. And adjusted EBITDA, which, is often your best measure for operational cash flow, that increased almost 25% to $19.5 million.
And the margin expansion there is critical. The adjusted EBITDA margin improved by a very meaningful 90 basis points. It hit 12.9%.
And you can't talk about financial discipline without the cash generation.
Oh, absolutely. Free cash flow hit a first quarter record of $8 million.
Which is driven by that increased profitability plus some really efficient working capital management.
That right there, that's the kind of execution that validates their entire strategic focus.
And if we dive into the revenue mix, you can see that strategy playing out. They're deliberately pursuing high-growth, high-margin verticals, and it is paying off handsomely.
This isn't accidental growth.
No, not at all. It's targeted. Retail and e-commerce led the charge, up 25%.
Wow.
HealthTech followed right behind with 19.5% growth, and travel and logistics added another 15.4%. These are all sectors that require sophisticated, digital-first CX solutions.
Which is their sweet spot.
Exactly where IBEX excels.
That vertical mix is great, but let's pause on fintech for a second. Management made a pretty big deal about this vertical reaching an inflection point.
Right.
It grew 3.4% year over year, 6.8% sequentially. But, 3.4% is pretty low compared to the 25% you just mentioned. Are we sure this isn't just a temporary bump?
That's a fair question, and you have to hold that skepticism. The key here is really context. FinTech was a known headwind because of some specific client scalebacks late last year. So the significance of that 3.4% isn't the magnitude, it's the fact that it's a positive number now. The sequential growth, that 6.8%, that signals that new deal flow is finally overcoming that prior pressure.
So it's more of a directional signal. The bleeding has stopped.
It's the technical signal of recovery, not the volume of success just yet.
That makes sense. We should also acknowledge the decline in telecom.
Right, telecommunications. It's their smallest vertical, and it saw a decline of 22.5%. But like we said, that was more than compensated for by the strength and really the higher margins everywhere else.
So let's look at the geographic mix because the strategic pivot there is crystal clear.
It is. Their priority to expand in high-margin regions is working. Offshore revenues, which are their most profitable locations, grew 20% this quarter.
And onshore isn't slacking either. Onshore revenue was up 21%. But that growth was specifically driven by their high-margin digital acquisition services.
And when you put it all together, offshore up 20%, digital and omni-channel services now growing 25% and making up 82% of total revenue.
It's a powerful validation of that mix shift. The focus is strictly on quality revenue.
And that focus translates directly into operational excellence and what management correctly calls their deep and wide competitive moat.
A moat built on efficiency and quality. Let's talk about that efficiency for a second. That SG&A metric is fantastic.
It really is.
They got significant operating leverage by holding selling, general, and admin costs relatively flat, while revenue just took off. SG&A dropped from over 20% of revenue last year down to 17.5%.
Right.
But how? I mean, how do they get that kind of leverage? Or are they just cutting back? Or is this the classic sign of a truly scalable model?
No, this is scalability 101. It means the infrastructure, the tech, the management layer, the back office. It's absorbing that 16+% revenue growth without needing a proportional increase in headcount or resources.
So they're leveraging existing facilities and automation.
Exactly. For you, the investor, this signals that every incremental dollar of revenue is going to cost way less to service, and that means massive flow through to the bottom line.
And that discipline is supported by some extremely high client loyalty.
They reported outstanding client revenue retention, over 98%.
98. That's sticky.
That level of stickiness is built on trust, which you can see in their service metrics.
And this is where it gets really interesting, really differentiated. Their employee NPS, which is a key measure of employee loyalty, it hit an all-time high of 77.
And client NPS improved to 71. That's up from 68 a year ago. Management made a point to say that anything over 70 is considered world-class.
Okay, so happy employees, very satisfied clients. How does that translate into the sales funnel? Did a high client NPS score directly lead to more of those trophy wins?
Absolutely. It's the direct link. It underpins their entire land and expand strategy.
Right.
When you hit a 71 client NPS, you're seen as a strategic partner, not just a vendor. And that quality is why their new logo engine is working so well. They won 7 high-profile new deals against much larger competitors in just the last 2 quarters.
So their advantage is in price.
It's service quality and superior execution, period.
Okay, so let's pivot to those land and expand metrics. They show just how quickly those new trophy wins are scaling up. The comparison to 2 years ago is, well, it's stunning.
It's genuinely powerful evidence. The number of clients generating over $1 million a year in revenue, that's up nearly 24% compared to 2 years ago.
A solid base.
Yeah.
But the real acceleration is in that middle tier, the $10 to $20 million bracket.
Oh, yeah. That group is up almost 67% over the same 2-year period.
67%. That's explosive growth. It suggests those initial wins are becoming major contributors very, very quickly.
Correct. That's the most powerful indicator of future growth, because those are the clients that graduate to the blue chip spending level.
And even the big spenders are deepening their relationships.
Right. The average revenue from clients spending over $20 million a year is up about 14%. So the strategy is working across every single client segment.
All right, now let's move to the AI vector. For you, the long-term investor, this is becoming the most anticipated driver for future growth.
For sure. Management signaled a very clear strategic shift here. They noted that Q4 of last fiscal year marked the transition from proof of concept, or POCs, to full-scale deployments for several key clients.
This shift is huge, and you have to see it as a dual advantage.
A dual competitive advantage, exactly. Internally, AI is making their human agents more efficient. Better tools, better performance. Externally, they're deploying it for automation and real-time translation.
Okay, but if everyone is investing heavily in AI, what's IBEX's specific edge here? Aren't they at risk of being leapfrogged by companies that are going for full automation and just bypassing human agents entirely?
That is the critical question. And management argues their integrated model, seamlessly connecting AI to human agents, is what's future-proofing the business.
How so?
Because clients are getting hesitant to commit to competitors promising 100% automation. The tech's just not quite there yet for complex issues.
So IBEX offers a safety net.
It offers the best of both worlds. Automation for efficiency and human intelligence for those critical service moments. They're attracting clients who want a credible path, not a massive gamble on pure machine replacement.
And to accelerate that, they brought in Michael Ringman as CTO, a significant hire.
A very significant hire. And while they did confirm that AI is still real early in the game and not moving the needle on revenue and margin yet, they gave us a concrete timeline.
Which is?
They expect it to become a meaningful vector for growth and margin expansion by late Q4 of 26 and heavily into fiscal 27. So now we have a target to measure them against.
Now let's pivot and address the financial elephant in the room, the margin nuance. Gross margins saw a slight headwind in Q1, and they expect that to continue into Q2. If everything's so strong, why the pressure?
This is where we uncover the core investment thesis. It's what's often called the lag effect. The margin dip is driven by necessary investments that are being recognized immediately.
Okay, break that down.
First, they're ramping up huge new operations in India. That means upfront costs for training and facilities. Second, the gross margin is being pressured by those successful new client wins we talked about. They recognize the huge training costs immediately, but the revenue from those big successful clients is recognized over the deferred life of the contract.
Ah. So the costs hit the income statement in Q1 and Q2, but the associated revenue doesn't fully flow through until Q3 and Q4.
Precisely. It's a timing issue driven by success, not by operational weakness. This is growth initiation pressure, not margin erosion.
And this ties directly into capital allocation. CapEx, or capital expenditure, jumped to $7.6 million. That's 5.1% of revenue.
Up dramatically from 2.8% a year ago.
That's a huge increase in spending. Is that level of investment in offshore regions a risk, given the, economic uncertainty?
It's a calculated risk, but it's a necessary one for their long-term margin profile. That CapEx is going to their highest margin offshore regions. They are pre-investing to make sure they have the capacity to service the big clients they've already won.
It's an investment in future EBITDA margins.
Exactly. And all that strategic spending, combined with profitability, it actually led to better working capital efficiency. Day sales outstanding DSOs improved to 71 days, down from 75.
Okay, explain to the listener why DSOs matter so much.
DSOs just measures how quickly you collect payment from your customers. So improving the 71 days means they're getting paid 4 days faster than last year.
Which is a clear sign of tighter financial controls and better collections.
And it directly contributes to that record free cash flow we mentioned. That cash flow strength is what lets them buy back shares, which they did. 92,000 shares for $2.7 million.
All of this strength gave management the conviction to raise their full-year guidance for fiscal 26.
They raised both the floor and the ceiling. Full-year revenue guidance is now $605 to $620 million. Adjusted EBITDA raised to $78 to $81 million. They are confidently guiding for margin improvement in the back half of the year.
And before we move on, a quick nod to their operational resilience. Management specifically called out the Jamaican team recovering from Hurricane Melissa in under 24 hours.
And continued resilience in places like the Philippines dealing with typhoons and earthquakes. That commitment to BPO continuity is a huge unspoken part of their competitive advantage.
Agreed. It shows reliability under duress. So what does this all mean for you, the experienced investor?
Yeah.
This brings us to our This Is Not Financial Advice segment.
Okay, so we have a high conviction, maybe slightly aggressive but plausible trade idea here, pitched directly to our hypothetical investment committee.
And the thesis is all about that lag effect we detailed.
Entirely. The market knows about the raised EBITDA guidance, but it might be overly focused on the Q1 and expected Q2 gross margin softness. We know that softness is just successful investment.
The market sees a headwind, but management sees an investment in acceleration.
Exactly. So given the raised guidance, the exponential growth in that 10 to 20 million client tier, and all that CapEx in high-margin regions, we are betting on a rapid and substantial margin surprise in the back half of the year.
Do you think the operating leverage will be greater than what's priced in?
We believe it will be, pushing the full-year EBITDA margin to overshoot that guided 13%.
So what's the outrageous idea to capitalize on this?
A short-term options play. We would go long the short-dated, out-of-the-money call options. The assumption is that once that deferred training revenue starts to get recognized in Q3 and the new offshore facilities hit optimal utilization, the profit flow-through will just be massive. It's a bet on the delayed recognition of incredibly successful execution.
A compelling, if aggressive pitch, betting on that lag effect being the main mispricing mechanism. So, to recap the essential takeaways from this deep dive.
Exceptional revenue growth.
Driven by the optimal mix of high-margin geographies and services. This success is validated by massive client expansion and world-class operational metrics.
Their momentum is undeniable, and their strategic focus on that integrated human AI model is a credible form of future-proofing that gives them a distinct competitive edge.
Okay, so the final provocative thought for you to consider is this. Management explicitly forecast AI becoming a meaningful growth vector by fiscal 27. Given their track record of beating expectations, how quickly will the broader market start pricing that in?
Right. Will the market wait until Q1 of 27, or will that multiple expansion start next quarter as investors begin to anticipate that inflection point?
That anticipation is what will fuel the next leg up for this company.
It is.
And just a reminder, this discussion is for informational purposes only and is absolutely not financial advice. Thank you for joining us for this deep dive.